Hi, everyone. If you're starting to question the system and want to protect what you have earned, you will want to download our free Gold and Silver Protection Guide. It's a clear, easy to follow resource that explains why gold and silver have stood the test of time and how they can help you build real financial security even as the dollar weakens. You'll learn about which metals to consider and the plan that best suits your needs, not Wall Street's. So click the link or scan the QR code to get started today. You're not going to regret it. On deck today, Fed Chair Jerome Powell saying that longer-term interest rates are likely to be higher as the economy changes and policy is in flux. And markets celebrating a China-US truce, but will the party last? And of course, we'll be talking gold taking a bit of a hit this week as global financial market sentiment seemed to improve. But where does it go from here? We're going to cover all this today. Rick Rule of Rule Investment Media is my guest. So good to see you, Rick.
Daniela, a pleasure to be back with you. I was reminiscing when I got the invitation about the fact that you and I have been having these discussions for probably 20 years.
Yes. Let's start with, I couldn't wait to ask you about this. Because look, just last week, President Trump calling Fed Chair Powell a fool after the central bank reiterated that it's not in any hurry to ease monetary policy. And now Powell on Thursday coming out saying we may be entering a period of more frequent and potentially more persistent supply shock. It's going to be a difficult challenge for the economy, yada, yada, yada. And that higher rates are likely going to be the norm.
I think Mr. Powell is stating the obvious. I think that Powell and the U.S. political establishment has done what they could to lower interest rates. They put a lot of pressure on the near term, and the long term has risen without them. I think what you're beginning to see is the reassertion of control by the market of credit markets, what they used to call in the Clinton administration the bond vigilantes. I think there was some risk if they lowered the long-term curve that they would give a treasury auction and nobody would show. So I really think that what Mr. Powell did was acknowledge the obvious. The credit markets have understood the difference between the long-term rates and the short-term rates have been pretty dramatic, despite concerns about equity markets. Normally, when there's concerns about equity markets, the real money, the big money, flees into the bond market, in particular the long bond market. But the fact that there's concerns about the equity market and the long bond market has still been sold tells you that the Fed is losing control over the interest rate. And I think Mr. Powell just simply acknowledged the obvious. Mr. Trump has not yet found it convenient to acknowledge the obvious.
Right. Do you think that they're going to find a way to force his hand, though? He's not doing what the administration wants. And yes, the Fed is independent. I just think it's interesting, Rick, or I'll find it interesting how this is going to play out. I mean, I have a feeling it's going to get ugly here.
I do too. I saw this movie once before in my life in 1975. One of the great advantages of being old, Daniela, is that you get to see analogs. In 1975, the Fed probably intentionally lost control of the long yield. The interest rates on the long bond rose. There was a lot of concern about inflation. By the way, the gold price tanked. The gold price fell from $200 an ounce at the beginning of 1975 to $100 an ounce at the end of 1975. But the long bond market tanked too, as did equity markets, as did home prices. When the effect of the higher interest rates went through the economy, it took no prisoners. At the end of that episode, after 10 months of discipline, the Fed lost their nerve, lowered interest rates again, printed money. The gold market went on an unbelievable romp from a bottom of $100 an ounce to a high of $850 an ounce over 5 years. So it wouldn't surprise me even if there wasn't an overt policy of interest rate rises, if the Fed stopped trying to manipulate the long rate. But I think almost certainly that voter pressure and political pressure will, at some point in time during Trump's reign, cause the Fed to attempt to ease monetary policy and lower the interest rate again. That will be the signal for the gold community that the game is truly on, that
Wow.
the forces that be in the United States have decided that inflation is less of a concern than the maintenance of their political and economic power. I saw that in 1975.
You also mentioned the treasuries part of the equation. We see foreign demand waning for treasuries. If China doesn't show up or has the buyer, Rick, what do we do? The
That's
Fed steps in?
that's exactly what happens. That's exactly what happens. I mean, let's look at this. Look at the arithmetic. Forget the policy. Just look at the arithmetic. It all comes down to arithmetic eventually. In this country, we have $36 trillion in on-balance
Right.
sheet debt. We aren't making it smaller. We're increasing it by $2 trillion a year. This government cut that Mr. Trump talked about generated a continuing resolution to raise the debt ceiling and to run the fourth largest quarterly deficit in history. Um, but that's not the whole problem. A much bigger problem is the net present value of unfunded liabilities, entitlements. That's $100 trillion, according to the Congressional Budget Office. Each number, on balance sheet and off balance sheet deficit, increases by $2 trillion each, $4 trillion annually. Now, to put that in arithmetic context, the gross federal revenues from all sources, taxes, tariffs, fees, rents, is $5 trillion. We're increasing the on and off balance sheet deficit of the United States by $4 trillion a year, and our entire federal income is $5 trillion a year. How do you fix this? We do what we did in the decade of the 1970s. Coming into the 1970s, we fought the war on poverty, which we lost. We fought the war in Vietnam, which we lost. And what we had left over was debt. In the decade of the 1970s, we inflated away our nominal obligations. According to the Office of Management and Budget, the US dollar, in absolute terms, not relative to other currencies, but in absolute terms, lost 75% of its purchasing power. What you could buy for $250 in 1970 cost you $1,000 in 1980. And by doing that, we made the nominal servicing of our obligations possible because we didn't index taxes to inflation. That's what we're going to do again. Over the next 10 years, the US dollar will lose 75% of its purchasing power, which is how we will fund the $100 trillion in off balance sheet liabilities. We'll make the real debt 25 trillion while honoring the nominal obligation by devaluing the dollar.
And that's where I say, Rick, therein lies the beauty of gold. And
Correct.
when you really truly see it working for you is periods like this where you look, if you're a gold holder, you look at your your holdings in gold versus what's sitting in the bank. And I want to get back to gold. But to your point about the money print, because I had Lawrence Leopard on, author of The Big Print, on recently, who was talking a number as absurd or high as a $10 trillion print. I think that was on the low side. Does that number make sense to you?
You know what? These are bigger questions than me, Daniela. At our conference, I hope you ask that question to David Stockman. He's the most sober viewer of all of these that I know.
Yeah.
This math is so big for me. It's incomprehensible. I'm not a geopolitical analyst. I'm a credit analyst. I'm not ducking the question. It's just that the number is so big. I add and
Yeah.
I
Well,
multiply and divide. I don't do quantum physics, so I
well, well,
I
I
can't
think
get
you
to the
made
size
your
of the
point. You
yeah.
made your point by saying that within 10 years, you see the US dollar devaluing 75%.
We had that in the decade of the '70s. And by the way, you closed the loop. During the decade of the '70s, when the purchasing power of the US dollar declined by 75%, the gold price ran 30-fold. I'm not telling you that the gold price is going to rise 30-fold. We could talk about that. But I do believe that the gold rise will be more or less concomitant with the decline in purchasing power of the US dollar. And that's a pretty impressive number. I don't think that in real terms the gold price is going to go up at all, but I think in nominal terms that it'll maintain its purchasing power against a currency that declines 75%, just like in the decade of the 70s. I'm not talking about science fiction. I'm talking about history and arithmetic.
On that note, I'd like to get your thoughts of how an investor, gold investor specifically, should look at the fluctuations we're seeing in the gold price. If you watch my show, I've had experts warning, don't get, during this run up, don't be surprised if we're going to see corrections or major fluctuations here. So we have been warning about it. And this week, gold did take a hit, on the news of some sort of truce between China and the US. Your thoughts of how you should be viewing the gold price and how to stomach it.
Daniela, I'm old and fat and rich. Um, and I became that by not being overly concerned day to day. As you know, I've graded tens of thousands of investment portfolios for free for 25 years. And I've noticed that a lot of investors make the same mistake continually. The first is that they confuse volatility with risk. There isn't an asset class that I know of that hasn't been up or down in the near term 10% for no reason whatsoever. The second is that while most investment investors get the strategy right, those strategies are long term, and most investors utilize short term tactics against the long term narrative. And that's almost a guarantee of loss. If you believe that over 5 years, the gold price is going to double or triple, but you have trauma holding gold over a long weekend, what you're doing is employing tactics that are inconsistent with your strategy. Uh, Many investors focus slavishly on the price of something as opposed to the value. I own gold because I think its rise will mirror the deterioration in the purchasing power of the US dollar over 10 years. I couldn't care less what happens next week. I am a consistent purchaser of gold because I generate capital in excess of my needs for consumption. My own interests are served by lower gold prices because I'm investing for 5 years from now and 10 years from now, and I'd like to lower my average cost of gold acquisition. While I realize that my circumstance is different from the circumstance of many of your viewers, what I want the viewers to take away is if their strategy is a 5 year strategy, their tactic can't be a 3 week or 4 week tactic.
Because you're still buying gold, Rick,
Yes, ma'am.
and you will always be buying gold.
Not always. There have been times, 2009 was a time where there were other asset classes that appeared cheaper to me. Gold became liquidity for me. There were assets in 2009, particularly community bank stocks, that were so cheap that I had to sell some gold to buy them. Gold is both insurance for me and it's liquidity. If there's an asset class that is more attractive to me, I will certainly shift my portfolio allocation. But we're nowhere near that today.
I mentioned the tariffs before and how obviously the equity market was rejoicing to this 90-day truce. Is the party going to be short lived? I think more importantly, I just want to get your thoughts on how the tariff plays out here, Rick, and how much longer you think this is going to go on for.
I hope you can
If I had
tolerate
to cut
hate.
to the chase.
I hope you can tolerate hate in the in your social media comments. Tariffs are taxes, and taxes are bad. Our president, like our former presidents, are transactional, and what tariffs really are is a way to appeal to the basest part of the political instincts of his supporters, and also a way to punish his enemies and reward his friends. It is a political strategy that's spectacular. It's an economic strategy that's tragic. Tariffs are taxes, and taxes are bad.
I read this quote from Jeff Christian over at CPM Group. You know, Jeff, Rick. He said, if you go back to 1929, 1930 to Smoot-Hawley, the last time we had this degree of tariffs, they exacerbated the depression. Do you
That's
agree with
correct.
that statement? Yeah, okay. That that's not good.
Daniela, your purchasing decisions and your investment decisions should be made by you. Why would you suborn your family's preferences in future to your president? How can your president make optimal spending and investment decisions for 340 million Americans? Does he know you? Does he know your children? Does he know what you want to feed them for lunch? No. The idea that all of us would suborn our preference to somebody for somebody's own political gain so that he can assign those preferences as he sees fit is an insanity.
Jamie Dimon came out earlier today saying he still sees a recession this year. The people watching want to know what Rick Rule thinks.
He's smarter than me as an economist. I am what he pretends to be. I'm a banker, a lender. uh, I'm not an economist, but I am afraid of a recession. I think we're overdue for a slowdown. I think that we've had a liquidity-driven market for a long time. I think that confidence is receding. As confidence recedes, liquidity recedes. Uh, and so I'm afraid of a recession. I need to say I have much larger cash holdings in my portfolio that I've had for many years, despite the fact that I feel that real interest rates are negative and there's a penalty associated with cost. I'm running higher cash bonuses because I think there's a possibility, as opposed to a probability, of a real failure in confidence, a 2008 style failure of confidence. And 2008 was the single best investment climate of my life. In 2008, I had the cash, and the cash gave me the courage to take advantage of that correction rather than being taken advantage of by it. And I'm running cash balances because not that because I know, but rather because I fear both a recession and a liquidity-induced um, break in markets. If it doesn't occur, the only thing that happened was that I had too much cash. I've had periods of time in my life, Daniela, where I've had too much cash. I've had other periods of time when I didn't have enough cash. And ironically, I found myself happier when I had too much cash.
What's going to be the signal, Rick, that that '08 repeat has a
I
high
don't know.
likelihood of happening?
If you ask me what I'm most afraid of, I don't know I don't know what the cause is going to be. If you ask me what I'm most afraid of, it's high yield, poor credit corporate debt. And the fact that so much corporate debt is held in exchange traded income funds owned by people who haven't done credit analysis, but rather have been chasing yields. If we have a disconnect between, um, if people become afraid of credit quality and begin to sell those ETFs, well, the ETFs are highly liquid. The assets that they control, the junk bonds, are not highly liquid. And as investors sell the ETFs, if this occurs, the managers won't be able to sell the bonds underlying the ETFs in sufficient quantity to fund redemptions. That's a classic bank run. Daniela, early in my career, I spent a lot of time in high yield bonds, very liquid bonds. And we used to have a saying for a high yield bond that you had to sell. We called them owl bonds. And we called them owl bonds because you'd call your broker and ask him to sell the bond. And your broker would say, to who? To who? And if you ask me the one thing that scares me the most, it's the trillions of dollars in high yield ETFs owned by financially unsophisticated ma's and pa's that haven't considered the implications of a credit squeeze.
That would be disastrous, Rick.
I'm not saying it's going to happen, uh, but when I talk to people about why they own these high yield ETFs, I probably talked to 1,000 individuals.
Yeah.
about that.
That's a good
Their
sample.
their lack of knowledge is scary. And the disconnect in liquidity between the trading volumes of the ETFs, which trade billions of dollars a day, and their underlying assets, these junk bonds that trade every 6 weeks. Um, I really, truly hope it doesn't happen. Uh, I personally am really, truly ready for it if it does,
You're ready because you
because I have cash, because I understand the junk bond market, and as those managers have to sell bonds, I'll be buying some at 15 or 20 cents on the dollar. My cash and my education means that I will take advantage of the situation rather than being taken advantage of.
wow, well, okay. Hopefully,
Hopefully, I'm
hopefully,
wrong.
hopefully you are wrong. Um, Final point, Rick. Let's talk your show. Let's talk some good news,
That
please.
is good news. I mean, particularly good news. I think because one of my hosts and moderator is going to be Daniela Cambone. I'm absolutely delighted that you'll be with us this year.
I am honored. I am honored, Rick, to come back. I always say it's the must attend show. Rick did not pay me to say that. I mean that from the bottom of my heart and as a service to everyone watching. You have to attend this show, but I'll let Rick explain it.
Let's talk about why. We've been putting on this show for about 30 years, and every year we made it a little better. If you assume that our competitors who've been putting on their shows for 5 years have made theirs a little better every year, 30 years of making things better is better than 5 years of making things better. We have a core group of attendees that have been coming for many, many, many years. These are smart, smart, smart people. So you don't have to worry about a circumstance where all of the knowledge in the room emanates from the dais to the crowd. The fact is that the crowd has spectacular knowledge too, and you'll be able to learn from each other. We do think differently than other conferences too, in that we teach you global macro from a very different perspective. Macro isn't taught by influencers per se, but rather by players. David Stockman uh, speaks about the budget from the belly of the beast. He's not a failed journalist. He ran the Office of Management and Budget under Reagan. He was a player. We have Nomi Prinz talking about the corrupt structure of Wall Street because she was a former partner at Goldman Sachs. She's not a journalism grad from some Pinko University. We have Daniela DiMartino Booth talking about the Fed because she was a researcher at the Dallas Fed. We have Jim Rickards talking about the intersection of Wall Street and government because he was general counsel at Long Term Capital Management, whose failure almost took down Wall Street. Even our so called generalists, Grant Williams, was a senior trader on European bond desks and then on Asian desks. He spoke from the belly of the beast. So we have a big picture perspective that you can't get from CBC or CNBC. Not a journalistic perspective, but a player's perspective. In a biblical sense, our speakers speak from the belly of the beast, an important differentiation. We move on from there to superb analysts, superb uh, portfolio managers, people who have been in our markets for 4 decades. Not somebody who flunked out of crypto, who failed as a bond analyst, but rather people who've allocated in precious metals and natural resources for 30 or 40 years. We move on from there to entrepreneurs, the Robert Friedlands of the world, the Bob Quartermains of the world, the Randy Smallwoods of the world, people who have built multi-billion-dollar companies. By the way, our mutual friend Frank Justra, people who have built multi-billion-dollar companies from scratch, describing the process, telling how it made them better investors, telling you what mistakes you make, and importantly, telling you how to identify the $20 million company that could become a $5 billion company. Further, Daniela, every single exhibitor at my conference, public company exhibitor, is owned and accounts owned and managed by me. They're vetted. We turn down more exhibitors than we accept. At every other conference on the planet, the qualification to be an exhibitor is a check that cashes. The lame, the halt, and the blind, as long as they're semi-solvent, can come. Finally, and this might be the most important, Whether you attend my conference live or via live stream, we're going to give you 50 to 52 hours of programming. You're never going to be able to absorb it all. So we record every smidgen so that you can play the tapes for a year and refresh yourself with the knowledge. We interview every single exhibitor before the conference so that you can allocate your time and your capital more efficiently. And if that weren't enough, irrespective of whether you attend live or via live stream, you have an absolutely solid gold money back guarantee. If you think as an attendee for any reason that I didn't give you your money's worth, I give you your money back. No other conference on the planet has enough confidence to make that true. The financial risk of you attending my conference is all mine. Absolute money back guarantee.
There you go. That's why you got to attend, folks. We'll have we had the link on while you're speaking, Rick. So um, that's where you go to register, and we'll also have the link in the description below the video. So it's everywhere. You can find it. Click on it, register, attend in person, like Rick said, or live stream. Rick, we look forward to seeing you in Boca Raton, July 7th to the 11th. And thank you for today.
Daniela, I'm delighted. I hope you and I hope your listeners attend the boat cruise, where
It's good
you
fun.
can digest all of the
Yep.
information from the conference over a spirituous beverage provided by Rick while sailing up and down the Intercoastal Canal.
It's pretty how could you say no to that? It's great fun, and you're learning and seeing all your favorites. Everyone that comes on my show is probably going to be there. So there you go. Rick Rule, thank you again. Like I said, we'll see you in July.
Thank you, madam.
It's coming up.
I look forward to future interviews, and I look forward to your presence in Boca Raton.
You got it. And thank you all for watching. We'll have more content coming your way. Be sure to sign up at danielacambone.com. We'll see you soon.